In this video, traders, we're going to look at the pros and cons of using a bar or candlestick close stop rather than a touch. Stay tuned. Hey guys, warm welcome to you. Alright, so stop losses. There's a different school of thought, two schools of thought should I say, of how to operate a stop loss. One school of thought is that, hey, when that price is touched, you give it no more room, you cut it, you get out of there, and you look for the next trade. You take your medicine, you move on. Now, another school of thought is that unless the bar closes above your stop level, you stay in the trade. So let's look at the pros and cons of both. So if you look at the, let's look at this Euro USD chart. Let's look at some actual examples. Let's say, for example, we just pick one here. You decided to go short on this this kind of resistance level here, and you decided to have in fact you probably let's say a resistance level here, and you decided to have a stop above the last highs. This is a 1 hour chart, by the way. You've got 1, 2, 3 highs. You went, right, you know what, that's going to be my stop loss level, and let's put kind of this is a dash level to, or dotted level, whatever, to say it's our stop loss. Fine. Now what you're saying basically is, hey, if it goes above 1.18, I will come out. So this candle here, let's zoom in a little bit on this candle as a great example. As it starts to go above, you're going to get stopped at 1.18, so whatever, 1.1, a little bit. Let's say the stop was just above those prior highs, which is never going to be on the highs, it's going to be just above. Say it's there. That's going to stop you out of the trade. Now, that might be okay, but of course, if the market's just oscillating around, you don't want to be stopped out of the trade. And if this was an example here, you'd be pretty frustrated because a few hours later the whole thing completely collapsed and you had opportunity to take a very nice profit on the trade. Of course, this is a hypothetical example, guys. We'll look at some others as well. But the reason that you would want to come out of a trade as soon as it touches it, or the pros and cons, if you like, let's go back to the initial question, is you're guaranteeing the price you come out within reason. Of course, you get some slippage depending on the market you're trading, etc., the gaps, all that kind of stuff. But reasonably well, you're guaranteeing the fact that if the price goes there, you're coming out at 1.18. So you can qualify how much you're going to risk. You can say, hey, I'm going to risk $1,000 on this trade, $500, $100, whatever it is. And if the price goes there, I know what size I am, I know my entry, that's my loss. Fine, very easy formula to calculate. And you're not also going to get caught on something. If this market had gone absolutely haywire and ripped up and up and up, you're not going to get caught on that. You know where you're going to come out of the trade, right? You're not going to be surprised in any way. You know exactly the level you're going to come out within a few pips. That's fine. Now, so that's the advantage of it. And let's say, for example, you did it on this trade here. Let's say you shorted this, kind of pulling back in here. You put a stop above there, then you'd be stopped out straight away above there. Fine, you know what your risk is. Now, the other way of doing it is to wait for the market to close above. Now, what that's doing is basically saying, hey, markets fluctuate back and forth. I want to see the market actually hold that level at a specific point in time before I decide to cover the trade for a loss. In other words, if it's wicking up in here within the hour and coming back, you're basically saying, I don't think that's genuinely a reason to come out of the trade. I'm prepared to stay in the trade as long as we don't close above. Now, the advantage, of course, is that it allows you some market oscillations. You know, if you're trading, especially something like Euro USD that's got wicks all over the place, so especially some of the markets that are very, very wicky and back and forth and rotational, it means you're not locking in your loss as soon as it tags a level. It means you're giving it some chance to rotate back and forth and have a bit of noise, and you're kind of giving the market a little bit of room to breathe. And you're basically saying, well, if it actually closes above it, then I'll have to cut it. Now, the downside of that, of course, is that you are susceptible or vulnerable to the market going further and further and further and closing wherever it wants. You know, within an hour, it could break it within the first few minutes of the hour, the candle, and then keep going and going and going. Like, for example, this one here, you know, or the one we talked about, which was here. You know, it goes up and up and up, and there's a massive amount of slippage, way more. It's not slippage, is it? But a massive amount of difference between the stop level from here to here. It's a significant difference. You might end up doubling or trebling your loss. So, if you did that, you are really kind of open-ending your risk, and that's a little bit of a danger. Now, you're not going to get stopped as much because of the flexibility of the nature of the stop. But there is a pro and con to everything, guys. There's no free lunch in trading. You've got to weigh up what's right for you. And that is one downside. You could get caught in a really big move that just goes and goes and goes, and you're in trouble. Now, the other kind of counter to that is that, when you say the close of a bar, it's only one specific point in time. If the price was kind of oscillating around at lows, and then in the last 5 minutes went up and pushed there, and the bar effectively closed there, it's almost meaningless, you could say, because yes, the timestamp of the bar is saying it's at the top of the hour, that's the close, but it's only in 5 minutes it's done it. So the argument is, well, it's arbitrary number anyway, it's an arbitrary figure. You're using a candlestick with a specific timestamp. Now, one way you can get around that is you can kind of start the hour from the point that it goes above it. It's getting a little bit advanced here potentially, but let's say it goes above 1.18. You can say, right, I will give it an hour, or I'll give it 15 minutes or whatever it is from this point. And if it stays above it within 1 hour from the time it's gone above it, I'm out of trade. If it doesn't, it comes back, I'm staying in the trade. So you can start the clock effectively on your own timer when that level is breached. So rather than just doing the arbitrary time at the top of the hour and effectively getting stopped out if it went a minute before and then suddenly went above, you're out. You say, okay, I'm going to give it time. If it's just noise, I expect it to go back and forth. That's another way of playing the game. So there's the pros and cons, guys. I think it depends. My personal opinion is it depends on the strategy you're taking. If you're taking a momentum type trade, very aggressive trade, you don't want to give it time to come back. Time is not really on your side. Momentum is snappy, it's got to go. If you're trading a mean reversion, you need a bit of time for the market to unwind. Maybe it's at a top, it's triple topping, it's rolling over slowly, it's a cup and handle off lows. Then maybe you do need to give it a bit more room, but also understand that you're taking a little bit more risk, so accommodate that risk with a bit smaller size as well, and being mindful that you could get kind of really caught out. So maybe you can have an emergency based stop and go, right, well, there's an emergency stop there. That's my kind of area that I might come out if we close above it. But if we do carry on even further, I want to mitigate the risk and just get out of the trade regardless. Anyway, guys, that's the kind of pros and cons. Let me know your thoughts of that in the comments section below. Take care. Bye-bye.